We're starting off with a story that's been making waves in the tech industry, the artificial intelligence boom, and its impact on big tech's spending habits. As investors, it's essential to stay ahead of the curve and understand the potential risks and rewards associated with this emerging technology. Recently, Chris Wood warned that the AI capex binge may burn billions as markets turn against big tech spending. This comes after announced results showed deteriorating free cash flow and sharp share price reactions from some of the world's biggest tech companies. Alphabet, for example, turned free cash flow negative in the second quarter of 2026 for the first time since its IPO in 2004. Meta shares also fell as its free cash flow plunged 91% to $784 million in the same period. On the other hand, Amazon's cloud revenue surge has been a bright spot, with the company's shares rising after announcing strong earnings and spending plans. However, Wood's long-standing view is that the hyperscalers will end up blowing a lot of money on their capex binge, and that AI could resemble the airline industry more than the winner takes all economics of the internet era. As we navigate this complex landscape, it's crucial to consider multiple perspectives and evaluate the potential outcomes. Will big tech spending on AI pay off in the long run, or will it lead to significant losses? We'll be exploring these questions and more as we delve deeper into the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating story about the world of artificial intelligence and high-stakes investing. Meet Leopold Aschenbrenner, a 24-year-old hedge fund manager who made waves with his firm Situational Awareness. Aschenbrenner's big bet on AI stocks had been paying off, with his fund growing to as much as $45 billion at the beginning of July. However, things took a dramatic turn when the AI trade began to unravel, and his heavyweight holdings like SK Hynix sharply crashed. Aschenbrenner's story is a cautionary tale about the risks and rewards of investing in emerging technologies. On one hand, his firm's success was built on a solid thesis that powerful AI systems would require vast expansions of chips, memory, data centers, and electricity generation. On the other hand, the sharp downturn in AI stocks has left his investors reeling, with losses of around 67% in July alone. It's worth noting that Aschenbrenner has taken responsibility for the fall, attributing some of the blame to short sellers who targeted the shares he owned. He's also vowed to run his public stock portfolio without leverage while drawing lessons from these developments. This saga serves as a reminder that even the most promising investment strategies can be vulnerable to market volatility and unexpected twists. As we explore this story, it's essential to consider the broader implications for investors and the tech industry as a whole. The AI bubble has sparked both excitement and concern, with some experts warning of a potential crash. While it is impossible to predict the future, one thing is clear: investors must be cautious and do their due diligence when navigating these uncharted waters. Welcome back to the Riskwiser Zone. Today, we've been exploring the intricacies of the financial world, and now it's time to dive into our final segment. We're going to discuss the recent earnings call from Coinbase Global Incorporated, a leading cryptocurrency exchange platform. The company is shifting its focus towards an everything exchange strategy, aiming to decouple its revenue from Bitcoin cycles, which currently comprise only 12% of its business. Management emphasized the importance of transitioning from a transaction fee model to a multi-product ecosystem with asset accumulation as the primary driver for cross-selling. They're also focusing on agentic finance, positioning Coinbase as the primary infrastructure provider for AI agents that require reliable, compliant, and low-latency settlement. The company reported growth in subscription services, particularly with Coinbase One, which reached an all-time high in paid subscribers despite a broader market downturn. Management attributes this success to the trust moat they've built, prioritizing reliability and compliance over being the absolute lowest cost provider. Looking ahead, management is optimistic about the Clarity Act passing but has a contingency plan in place if legislation fails. They're expanding pre-IPO perpetual futures to U.S. customers and intend to aggressively share economics with partners to ensure USDC becomes the #1 stablecoin across all metrics. While some may view the emergence of competing exchange-led Layer 2 chains as a threat, Coinbase management sees it as a natural market fragmentation that will eventually lead to consolidation. They are confident in their position, highlighting Base's 2-year head start and its leadership in stablecoin transfer volume and agentic finance. As we wrap up today's episode, it's essential to remember that the financial landscape is constantly evolving. Companies like Coinbase are adapting to these changes, and investors must stay informed to make educated decisions. Whether you're a seasoned investor or just starting out, it's crucial to approach the market with caution and consider multiple perspectives. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.